Well, good morning and welcome to the Texas Mortgage Bankers Association 2025-2026 Educational Webinar Series. It's a part of the Education and Endowment Committee of the organization, which was led this past year by myself, Tom Couture, and my co-chair, who couldn't be with us today, Elizabeth Miller. We also have with us today Emma Henderson, who was the subcommittee chairperson for this. Today, our topic is the long-run interest rate outlook. This webinar should take about an hour, but feel free to ask questions during the hour in the chat box, if you will, and we'll save those questions to the end and field them at that point in time. So just please put them in the chat box. Today's speakers join us from the Texas Real Estate Research Center at Texas A&M University. We have Pamela Canon, Executive Director, and George Barro, a research economist. So I'm going to turn it over to Pam right now, and she'll take it away.
Thank you so much, Tom. We are so delighted to be here with you today. Thank you. I am Pamela Canon, Director at the Texas Real Estate Research Center. I've been at the center about a dozen years, about 2.5 in my current role. And I thought there might be quite a number of you out there who don't know too much about us, about the center. So I just wanted to take a minute or two and give you a little bit of background. We are probably the largest publicly funded research center for real estate and rural and urban economics, certainly in the nation, but probably beyond. We were founded in 1971, just celebrated 55 years this month. I know we haven't been around as long as the mortgage bankers, though. You are substantially older, and we are just a small team of about 20. So most of the people in the center were born after the center came into being. We were created by the Texas legislature when a commercial broker went to the State House with the idea of creating a research entity for his industry. They agreed with him that it was a good idea and created the center. They provided a funding stream for us and placed us at the state's land-grant university, Texas A&M, for academic and operational support. And when the center started out those decades ago, there was not too much data to be found, or maybe no data was even available. But I've heard some of those stories where the researchers would drive around local communities all over the state, and they would talk to local business people in the industry, economic developers, bankers, and they wanted to learn what was happening in those communities. And a lot of their research originated by that face-to-face kind of knowledge and information. As we've grown through the years, obviously we now rely heavily on both public and private data for our research, but sometimes the old ways are still the best, certainly important. We still want to learn from the people on the ground, meaning organizations like yours. It makes the data personal and real. And when we can verify our data with the actual experience, then knowledge that you have, it feels like we have done our jobs well, and we have provided information that matters. The Texas Mortgage Bankers and the Center have been longstanding friends. We've had a long relationship, certainly thanks to Scott Norman, Aaron D., and now Pam Jenkins. But before any of us were on the scene, the mortgage bankers were important to the center. We've always had that sense of you're the ones who know what's going on in your industry. We wanted to learn from you. Our research is extensive. It ranges from housing, both single family and multifamily, to commercial, to rural. We study legal and policy issues, as well as the general macroeconomic trends. And we have a broad-based constituency of trade associations, brokerage, builders, bankers, state and local governments, policymakers, appraisal and tax professionals, the business community, as well as just individual Texans, citizens who need more information to make their own decisions. We make efforts to listen to our constituents. We want to know what matters to them. We have a self-directed research agenda, and all of our work is published on our website. We're easy to find. If you just Google us, Texas Real Estate Research Center, you can find us. And we publish in-depth reports and articles and columns. There's a blog where our researchers can muse about the economy, that we get to see a little bit more about what they're thinking. And there is just a variety, pages and pages of data. Our flagship publication is a quarterly magazine, the Tierra Grande, which is also available online. Last year, we published our first themed issue, which was on the topic of water in Texas. And this summer, we'll produce another themed issue on housing. Later this year, we'll publish the first annual State of Texas Housing Report. So each January, we also look ahead with a forecast issue to help readers make sense of what we see happening. Our researcher who is here today, Dr. Barro, has been instrumental in the development of our forecasting efforts. He came to the center about 15 months ago with a very distinguished career path. He had previously worked at Rice University's Baker Institute of Public Policy and also at the Wharton School at the University of Pennsylvania. In both of those roles, he developed macroeconomic models and is a founding contributor to the Penn-Wharton budget model. He completed his Ph.D. work at the University of Texas at Austin, Scott. So I do want to turn it over to him. George, Dr. George Barro has his presentation ready to go.
All right, well, thank you so much, Pam, for the introduction, and thank you to everybody here at the Texas Mortgage Bankers Association for the opportunity to give this talk. Really, Pam talked a little bit about, my past in macroeconomic modeling. And to a large extent, it was to answer some of the hardest questions that we have in macroeconomics, like, why have interest rates behaved the way that they have over the last several decades? And I'm going to share some of those insights today. And the name of the presentation today is Long-Term Interest Rate Outlook. So what we're going to be doing is zooming out a little bit from kind of the cyclical fluctuations of interest rates and focus on what factors are driving long-term interest rates. And the reason that we want to do that is because if we understand which factors have driven interest rates in the past, and if we can project those factors, we can get a sense of how interest rates will change moving forward. So the backdrop today is actually a picture of Jackson Hole, Wyoming. This is where the Federal Reserve hosts their annual conference. It's in August, so it's coming up here in a few months. And I'll talk a little bit about what was discussed in the most recent Jackson Hole conference and how it relates to interest rates moving forward. Let's see here. So I'll start off by talking a little bit about historical U.S. interest rates. I'll try to focus mostly on mortgage rates, but it's hard to talk about mortgage rates without talking about what's happening in the 10-year Treasury yield market. I'll make some long-term projections, and then I'll spend the last few minutes of the presentation today kind of coming back to earth a little bit and looking at the short to medium term outlook regarding Fed policy and mortgage rates. So this is a graph of the 30-year mortgage yield going back to, I think, 1972, coincidentally, the founding year of our center. This is something that looks very much like the 10-year Treasury yield. I think if you were to deduct about 150 basis points, you'd be down to, to some approximation, the 10-year Treasury yield. And if you were to deduct maybe another 200 basis points or so with fluctuations over time, you'd be at what economists call the real interest rate, which is the interest rate net of inflation, which we would argue is what really drives decision making. And so this is something that has really puzzled economists for a long time, in the sense that we had a surge in mortgage rates and broader interest rates in the 1980s. And then ever since then, leading up to the pandemic, we had a long-term trending decline. Like pretty significant. In the 1980s, we had mortgage rates that exceeded 18%. And, in the recent years following the pandemic, they were as low as 3%. And that's why I always say, never complain about 6 to 7 percentage point mortgage rates to anybody who bought a house in the 1980s. But this is something that has really puzzled economists for a long time. This is a survey of professional forecasts. This is, at every point in time, each one of these separate colors is a forecast of the 10-year Treasury yield. Going back maybe 15 years or so, they started expanding the forecast horizon, and that's why some of these lines are longer than others. But what you'll notice is that almost at every point in time, economists overestimated where they thought interest rates would be in the future. It's almost like there was this expectation of maybe mean reversion, and to some extent, these are built into the models that economists use to forecast interest rates. But the bottom line is that for a long time, economists were way off. And at every point in time, we thought that interest rates might bounce back up. And I don't just mean to pick on, forecasters. This was a series published by former Fed Chair Ben Bernanke in 2015. This is a 4-article series titled "Why Are Interest Rates So Low?" Now, here, of course, he's not necessarily talking about the interest rates that are set by the Federal Reserve, which are very short-term overnight rates, but he's talking about real interest rates net of inflation. And this is something critical for central bankers to get right, because the way they implement monetary policy has to rely on accurate measurements of the real interest rate and where it's heading in the future. And so Bernanke offered 2 hypotheses. One was that there was this global savings glut, basically that worldwide savings was very high and growing in the 2000s, largely driven by Asian countries, particularly China, that had a very high savings rate. And the second hypothesis was the so-called secular stagnation hypothesis. This is something that this is a term that was coined about 10, 15 years ago. And since then, the definition of this has somewhat evolved. But fundamentally, what secular stagnation sort of captures in its concept is this idea that demographics, to a large extent, are influencing capital markets. And in the years since then, we've learned a tremendous amount about capital markets, and we've had kind of a growing consensus in the field that demographics are playing a major role in driving what we're seeing in asset markets and in interest rates. And so I'll give you a quick overview of kind of what this theory suggests, so that we can have some sense of what we might anticipate for future interest rates. So this is a life cycle, what economists will call a life cycle wealth profile. It shows average wealth by age. This is probably not too surprising. As you enter the labor market, your assets are very low. You tend to build assets leading all the way to retirement, and then late in life, you start drawing from your retirement savings and decumulating. So capital market theory would suggest that, the capital that we have in our economy comes from households, and so household savings in particular. And so if there's a shortage of household savings, then interest rates are going to be high. And conversely, if assets are very high, interest rates are going to be low. And so the demographic story goes as follows. Imagine that you have an economy filled with a lot of households that are, say, in this 35 or under age bin. You're going to have a small stock of capital relative to the size of the economy. And again, conversely, if you have a lot of people who are at or near retirement, you're going to have a relatively larger stock of capital relative to the size of the economy. And that's sort of fundamentally what this growing consensus in the field would suggest has been driving interest rates historically. If you flip back to the mortgage rate graph, at this point in time, when interest rates were very high, sure, we had high inflation, but even when you net that out, we had a surge in interest rates. You had the baby boom generation entering the labor market. So you had a lot of people with very low assets entering the economy. And then over time, this generation built a stock of wealth and pushed interest rates down pretty significantly over that time period. And so that, economists would argue, is what drove that sort of long-term decline in interest rates. And so this is maybe a bit of a hard sell here because, I'm not unaware of what's happening to interest rates today. But if you look at demographic projections, you can see that at the moment, we're in a very steep part of the aging of the U.S. economy. We have this is what we sometimes call the old age dependency ratio, the ratio of those 65 and older relative to the 15 to 64 age group, which is sometimes used as a proxy to understand the implications of things like Social Security and Medicare and other age-dependent variables, but policy variables. But we can use it here to get a sense of what we might anticipate for interest rates moving forward. And so, given the demographic outlook, it's likely that the role that demographics play in capital markets would lead to downward pressure in the interest rates as a result of what I've often called a demographics-driven surge in savings. And by the way, that's not just what's happening here in the United States. If you look across all OECD countries, we're experiencing a significant increase in wealth of those countries as a result of the aging of the population. Each one of those countries is experiencing a significant aging and a corresponding decline in their national interest rates. And so as a result, if you project over very long time horizons, you get a projected downward pressure. Maybe decline was the wrong word here, but definitely a projected downward pressure in interest rates. But demographics aren't the entire story. There are some countervailing forces right now happening in the economy that are putting significant upward pressure on interest rates. And I'll save the discussion of inflation maybe for another day. But what we're focused on mainly is, capital markets net of inflation, what's happening to asset supply and asset demand in the economy. So right now, we're in a big cyclical increase in investment. So the AI build out, according to a recent Goldman Sachs publication that came out just a few weeks ago, there's projected to be a $7.6 trillion increase in CapEx related to AI infrastructure building over the next 5 years. So this is likely to be something that puts upward pressure on interest rates. The second factor that's somewhat unique to treasuries and mortgage rates is the Fed balance sheet policy. For a long time, the Fed accumulated a large stock of capital and we'll come back to that in a few minutes. But it's, the Fed has become an increasingly important player in long-term debt markets. It historically had been more an entity that had influenced short-term rates, but over time, because of the evolution of monetary policy, it started purchasing long-term assets. So we'll talk about that in a minute. And then the third major factor putting upward pressure on interest rates has been the growth of government debt, particularly here in the United States, and same story across OECD countries. So this was the topic of conversation at last year's Jackson Hole meeting, and I wanted to kind of give a sense of how this discussion went down. I wasn't there, but they publish an overview of the research that was presented there, and there was a particularly interesting talk that was given by Harvard economist Ludwig Straub, and the title of the paper was called "The Race Between Asset Supply and Asset Demand," and basically, where the field is now the big question of what wins out over time between this sort of demographics-driven surge in savings that's pushing interest rates down, and a corresponding, you might even say, demographics-driven surge in government debt pushing rates up as we have, projected growth in Social Security outlays and other expenditures related to demographics. And so I thought this line from the summary paper was very interesting. It says that Straub stated that on net, he expects aging to increase equilibrium real interest rates in the next 80 years. Of course, this is a super long time horizon, but what I found even more surprising was the next comment, that this view was widely shared by the audience. This is a major academic conference held by both, representatives from academia and practitioners, the Federal Reserve, that are right where the rubber hits the road. And so pretty clear that, the growing consensus is that without stabilization of government debt, that this is going to be something that puts significant upward pressure. And so the next topic that I wanted to spend just a little while talking about was Fed policy and the mortgage rate outlook. So we're going to kind of zoom back to sort of the near to medium term outlook, and what Fed policy, the extent to which it might impact capital markets, and in particular, the market for mortgages. You can see that, so this is the Federal Reserve's holding of mortgage-backed securities. You can see that, if you go back to the turn of the year 2008, the Federal Reserve held 0 mortgage-backed securities. It was in the aftermath of the great financial crisis that the Federal Reserve felt it needed to do something more aggressive than just impacting short-term interest rates to get the economy from falling into an even deeper recession than the one that we had at the time. And so the Federal Reserve, and this had been an area of Ben Bernanke's research in the years preceding his chairmanship of the Federal Reserve, but he was a big proponent of exploring the acquisition of long-term assets as a remedy to the issue of interest rates very close to what economists would call the zero lower bound. And so the Federal Reserve started aggressively accumulating mortgage-backed securities in the aftermath of the great financial crisis. And it may have been a very appropriate thing to do at the time, considering that the deep macroeconomic downturn that we had was to a large extent specific to what was happening in the housing market, and in particular capital markets corresponding to the housing market, the mortgage market. And so, a few years after the start of the great financial crisis, the Federal Reserve began decumulating some of these assets. Then, they U-turned sometime around 2013 when they felt like housing market wasn't recovering fast enough. and began reaccumulating mortgage-backed securities. And this lasted until about 2014, when the Federal Reserve decided to stabilize their holdings of mortgage-backed securities. And then around 2018, the Federal Reserve finally decided to begin decumulating mortgage-backed securities, and they did this through balance sheet roll-off. So when people would pay off their mortgages that were held by the Federal Reserve, instead of buying new mortgage-backed securities, they would just reallocate that revenue to other sources, including treasuries. And so that didn't last very long. Unfortunately, the pandemic hit, and the Federal Reserve thought that we were facing another sort of very consequential, deep macroeconomic downturn like the one that we had faced in the great financial crisis. They accumulated a large share of the mortgage-backed security market, and I'm sure you're familiar with exactly what happened, a huge surge in valuation of homes. And ever since then, in 2022, the Federal Reserve sort of slammed on the brakes, really shot up short-term interest rates to counteract what was happening to prices in the economy. And then they reinstituted this decumulation of mortgage-backed securities through through their balance sheet roll-off. And so all that this is to say is that the Federal Reserve at some point became a major player in the mortgage market. And so this graph translates the mortgage-backed securities held by the Federal Reserve to the percentage of the mortgage market held by the Federal Reserve. So you can see within a relatively short amount of time, the Federal Reserve went from holding 0% of the mortgage market to holding around 15% in the aftermath of the great financial crisis. And then that shot back up again in the aftermath of the pandemic. And ever since then, they've been trying to backtrack and decumulate their assets. And so the big question now, as it relates to mortgage markets, is where will the Federal Reserve stop in terms of decumulating mortgage-backed securities? I think this is one of the most critical questions facing near-term mortgage markets. And just to highlight the extent to which Federal Reserve policy has impacted mortgage markets, this is a graph from a recent publication of mine that's in Terra Grande. Highly recommend reading it, of course. But this is the relationship between the mortgage rate spread over the 10-year Treasury yield, that's this blue line, and the Fed's change in mortgage-backed securities, their total holdings year over year. And so you see these green areas where the Federal Reserve began accumulating mortgage-backed securities. That put significant downward pressure on the mortgage spread. And these brief moments in time when the Federal Reserve, finally tried to catch their breath in the mortgage market and decumulate assets, that caused the mortgage spread to shoot up. Again, looking back at the pandemic, it didn't last long before the Federal Reserve began reaccumulating those assets, causing the mortgage spread to plummet. And of course, we slammed on the brakes in 2022. The mortgage spread shot up, and it's been easing up a little bit ever since. So, according to this graph, the Fed mortgage, the mortgage spread between, the 30-year mortgage and the 10-year Treasury yield has typically hovered around 150 to 175 basis points historically. So, we're not terribly far off relative to where we had been, but it's still, certainly my thought that the Fed is pretty significantly impacting mortgage rates through their decumulation, and a thought that I always go back to when I try to understand the implications of the Federal Reserve's role in mortgage markets is exactly this graph. So right at this very moment, the Federal Reserve is neither buying nor selling mortgage-backed securities, but that doesn't mean it's not having a big impact on mortgage rates. And I think this graph really highlights that. I mean, it has been doing the neither buying nor selling for the last few years. Still, its share of the mortgage market has shrunk as a result of them just not, reaccumulating the mortgage-backed securities that roll off of their balance sheet. And so all of this decumulation has to be absorbed by the private sector, plus any growth in the mortgage market, which I did a quick back of the envelope calculation. I think that, over the course of a year at any given point in time, the share of balance sheet roll off, relative to the growth in new mortgages is large. And so that's why I think the Federal Reserve is still having a big impact on mortgage markets. And so, when I think about what the possibilities are for the Federal Reserve sort of stabilizing their holdings of mortgage-backed securities, I think of a few different possibilities. And, this, of course, is just my opinion, reading between the lines of what members of the Federal Reserve's Federal Open Market Committee that vote on monetary policy have indicated, and just, a general sense of how these economists think and the implications for the broader markets. But, the first possibility is that the Federal Reserve stabilizes their holdings of mortgage-backed securities at pre-pandemic levels. And so let me switch back. If they cared about the actual dollar value of mortgage-backed securities, and they just wanted to get back to this pre-pandemic point, then they still have probably about, back of the envelope calculation, 1 to 3 more years of balance sheet roll-off before they get to that point. Another possibility is that they run their stock of mortgage-backed securities down to zero. To get close to that will probably take about 8 to 9 years, and that depends a lot on how mortgage rates move, because a lot of the mortgages held by the Federal Reserve are the mortgages that they accumulated in the aftermath of the pandemic, when mortgage rates were really, really low. And so a lot of these people are very reluctant to pay their their mortgages early. They're also reluctant to move houses because of this mortgage rate lock-in effect. And so that's something that has to be taken into consideration when we're thinking about how quickly the Federal Reserve might run off their holdings of mortgage-backed securities. And so if they wanted to run it down to zero, and if we assume that it just keeps going at the rate that it's currently going, we're looking at, maybe conservatively about 8 to 9 years. And, given the fact that some of the mortgage-backed securities that they accumulated were 30-year mortgages, it's unlikely that they would fully exhaust it until, 30 years after the time at which they stopped accumulating assets, which was 2022. But at some point, I would imagine that would be a very small amount, and the impact on mortgage rates would be very small. The third possibility is that instead of just letting mortgage-backed securities roll off of their balance sheet, that they decelerate the mortgage-backed security roll-off from their balance sheet. I think that this is more likely, that at some point, they might say, look, we know that this is having a big impact on mortgage markets. It's significantly impacting affordability. And so instead of letting, I think the number is roughly $17 billion a month rolls off of their balance sheet, they might cap that at, say, $10 billion and reinvest that money in mortgage-backed securities. That's more likely, I think. And of course, the fourth possibility, which is, the worst of all scenarios, is that we go into a recession. The Federal Reserve finds itself in the same situation that they were in at the start of the pandemic, where they're trying to decumulate mortgage-backed securities, but they end up having to reaccumulate mortgage-backed securities as a result of, the implications for the housing market and the financial markets and the broader economy. And this is where we can start talking about the Warsh factor. Kevin Warsh is the incoming Federal Reserve chair. His position is that the Federal Reserve should play a very limited role in its holdings of long-term securities, particularly long-term treasuries and especially mortgage-backed securities. So he's sort of a hawk in the sense that if it were up to him, I think that they'd run mortgage-backed securities all the way to zero. But one important thing to remember is that regardless of how influential the Fed chair is, the Fed chair is just one voting member of the Federal Open Market Committee. And so it's his job, if he wants that outcome, to grow a consensus within that 12-member FOMC. And so, I'll say one more thing about Warsh, and that's that Jerome Powell came into his role at the Federal Reserve with similar ideals as Kevin Warsh, in the sense that he really wanted to decumulate the holdings of mortgage-backed securities. It was something that he did in the years preceding. I say he did as if it was just his decision. Let's be clear, there's a Federal Open Market Committee and they all have to agree on it. But Powell's position was similar to Warsh's, but when a recession hits and you see credit spreads start shooting through the roof and it looks like we're in the middle of a massive financial market meltdown, I think about that old saying that there's no such thing as an atheist in a foxhole. And if Warsh is somebody who is sort of dogmatic on holding mortgage-backed securities in a very limited way, then the moment of truth would be if a recession hits. So there is the credibility factor. Obviously, the Federal Reserve under Jerome Powell's leadership caved in and accumulated massive quantities of mortgage-backed securities, and it's a lingering question as to whether or not Warsh would follow a similar path. And so on that note, I always like to talk about recession risk in the context of historical macroeconomic expansions. So macroeconomic expansions are defined as the time period in between recessions. And so this is every single historical U.S. expansion on record dating back to January of 1855. And so what you see is that expansions actually were decreasing in duration leading up to the early 1920s, when we had the Great Depression, and you had the creation of several financial market regulatory agencies. You had, the establishment of the Federal Reserve's regulatory powers in the 1930s. You had the SEC, the establishment of the SEC, the FDIC, and I'm not here to necessarily debate the merits of these regulatory institutions, but it was after the establishment of these, I'll at least identify the correlation between the establishment of these regulatory institutions and the subsequent increase in the duration of macroeconomic expansions in the United States. A lot of people argue that these regulatory institutions added a lot of stability to financial markets and that we've benefited from it significantly ever since. And so where are we right now in terms of the duration of our current expansion? If we went into a recession today, that's this green bar right now, that this growing green bar, if we went into a recession today, it would actually be tied for the shortest expansion in the last 40 to 45 years. So it's still a relatively short expansion, considering the trending increase in the duration of expansions. And so, I sometimes talk with people about recession risk, and of course, you have your typical indicators like an increase in the unemployment rate or a decline in GDP. But to me, one of the most telling indicators, just looking at the historical trend in business cycles, is the duration of the expansion. And so right now, our economy has been growing since May of 2020. And, it's hard to say at what point it becomes risky from this perspective, but I think that at least for now, risk is relatively low. But what I always like to issue is a disclaimer that recessions can happen at any time, and as the pandemic taught us, for any reason. And so, I'll sort of conclude today by saying that there's a strong case, and again, I know this is a tough sell because I'm very much aware of what's happening in mortgage markets right now. I know that rates are shooting back up, but I do think that a lot of that is a result of resurgent inflation, probably driven largely by the spike in oil prices. We see that spike in oil prices starting to affect core inflation. We saw that this past month. If you pay attention to the component inflation, shelter shot way up, and that's likely the result of the components of shelter inflation related to energy. There are concerns that inflation will be persistent, and I think that that's causing this cyclical increase in mortgage rates. But zeroing out and thinking a little bit more long term, I think for term interest rates. But of course, like we mentioned, that to which debt issues impact the economy, that is a choice, that is a policy choice. If there's efforts towards debt reduction, we could see the interest rate outlook improve from the perspective that we no longer have increasing interest rates as the result of government debt. But thinking even shorter, the shorter time horizon over the next 5 years, I do think that the AI build out will continue putting upward pressure on interest rates. What will be the net impact over the short term? I can't really say, but it's my general sense that over longer time horizons, my expectation would be that interest rates, at least over the next maybe 10 to 20 years, we could see it decline at least momentarily while fiscal issues are getting resolved. The Fed balance sheet just remains a big wild card. It's hard to predict exactly what the Federal Reserve will do in terms of either running its balance sheet, its mortgage-backed securities down to zero, or maybe stabilizing it over time. That remains a big question. We'll see how that unfolds in the months and years to come. And then finally, the last comment I'll make today is that there are a number of policy proposals that could have a significant impact on mortgage markets. And this is something that I'm covering in my most recent article in our quarterly publication, Tierra Grande, that addresses affordability. I have an entire section on issues related to mortgage markets and the policies, like, for example, the 50-year mortgage, and trying to understand the implications of that in the mortgage market. And so I, of course, encourage you to read it, and certainly reach out if you have any questions or comments. I'm happy to welcome any feedback. But so at this point, I'd be happy to take any questions if you have any.
Well, thank you for that, George. So far, there aren't. Well, actually, there is one from Jacob Holguin. Does the Research Center see Truflation as a credible and useful addition to the toolkit for informing interest rate decisions? Any perceived pros or cons with its addition?
Yeah, so let me say that first of all, I speak for myself here. I don't want to speak on the from a broad position of the center, but my general sense is that I do think that there is a significant role for private sector data that can help us make better decisions. For a long time, we've relied on, single sources of information, single sources of data. I do think that, we saw this particularly in the labor market when we had the federal government shutdown. We started relying on ADP data, for private sector jobs measurements. We also have, I think it's Revelio Labs that is trying to play a bigger role in providing private sector data. Truflation is another one of those data providers on the private sector side. I do think there's a role for it. I haven't looked very closely at it, but this is just a very broad statement regarding the the benefit that private sector data sources can play in understanding the economy and driving policy decisions.
Thank you. I have a question for you. Back on your slide that was comparing the interest rate spread between mortgage and 10-year, it's, as you said, it's coming down some while the Fed's been rolling stuff off their balance sheet. What's causing that, and how significant might that continue to get back toward that 150 that we all know and love?
Yeah, I think that is, what you're seeing is the difference between actively trading securities and just not being a player in the market. If that's my general sense. It's hard to say. We came very close. Yeah, so I typically consider 175 basis points to be the upper bound of that, stable range over time, maybe even 160 basis points. So we hadn't quite reached it yet. It's hard to say. It could be, the factors that continue to expand broader capital in the economy. I think about that a lot. And I also think about foreign investment in U.S. markets. So this is a, something probably isn't talked about in the context of mortgage. There's an economist, Maurice Obstfeld, he's an international economist studying international capital. We saw significant expansion of mortgage markets maybe in the late 90s and early 2000s. Some might argue overdevelopment of, in some cases, to the extent that it added risk to the economy, but that flows over that time period put significant downward pressure on mortgage rates. And so you can see a little bit, I guess that would just reflect stability in the mortgage spread around 150 basis points. But the big question at the start of the tariff war was, first, to what extent would it impact across countries, and how would it impact international capital flows? That is a very significant factor when you're thinking about our ability to fund our federal deficit and have well-functioning broader capital markets. And so the concern at the start of the trade war was that foreign capital inflows might stop. But what we actually saw was no deceleration in foreign capital inflows, and maybe even an increase in foreign capital inflows. And so we obviously didn't see that in broader capital markets, but we did see a little bit of a decline, again, with the exception of the last couple of months. We were seeing a trending decline in the 10-year Treasury yield and in mortgage rates. And so I think that may have played a factor, but you're right. I mean, this is kind of a counterpoint in the sense that if we were arguing that the Federal Reserve is having a massive impact, then why isn't the mortgage spread, remaining at very high levels. And so I think that's going to be something to watch over the next few months, whether or not it's able to come back down to that, like you said, 150 to 160 range that we love, or whether it remains at very high levels.
Yeah, thank you. Well, it doesn't look like we have any other questions in the chat or the question box, so I just would love to take a moment and thank you both for your participation with us today and for giving us your knowledge. It has been quite valuable. I think everybody should share this replay of the webinar with their colleagues that couldn't be here today. And I thank you all for attending today. Those of you who have, just want to say that the Texas Mortgage Bankers Association will continue to work on bringing great webinars like this to each of you. Check out our homepage at texasmba.org for the upcoming schedule. And also, as Pam mentioned, go to the Real Estate Center's webpage and get some of this great information there as well. And just want to remind you to register ahead of time for these webinars. In 2026 and 2027, we'll have a new great committee. Elizabeth actually will still be involved, and she plans to bring a lot more great content like this. And we'd love to have you guys back, George and Pam, another time next year to see how things are shaking out at that point. So,
Thank you so much.
thank you all. Appreciate it. And you all have a great day.